Thanks, Lori, and thanks everybody for coming. I'm always happy when other people will take time out of their busy schedules to hear something that I have to say, so I hope I don't waste your time. This is joint research with Mike Johannes, who's at the Business School, and Mike Chernoff, who's at the London School of Economics. So I thought it would be appropriate to talk about the returns from investing in options, because it really is a question of, is there a free lunch or not? And so this term has been around for a long, long time, decades. There ain't no such thing as a free lunch, and the question is, well, or is there? This seems right, complimentary free lunch, but what is it? It's coming out of your tuition? Is it coming out of our pay increase for next year? Is it really free? Where did it come from? Well, Wikipedia is great. Free lunch refers to the tradition of saloons when they give a free lunch for buying one drink. Wow, that seems like a pretty good deal. But of course, you're paying for it in the cost of the drink and other things. But it's an interesting question, and economists look at this question from the viewpoint of market efficiency. Are markets efficient? How do people behave? Are people rational? Are markets rational? How does this all work? Investors are interested in this question because we all would like to find good trades that have high returns and low risk. But both of these are asking, can you get something for nothing? Okay. So I'm an academic. I've spent some time on Wall Street, where there's a lot of common overlap between what we do and what they do. But one of the things you need to do in academia is to publish your research. You want to kind of bring knowledge a little bit further to the forefront. And if you try and write and publish this paper, the market for asset XYZ is efficient, what do you think is going to happen? Well, it's not going to get published. It's not a surprise. If you say the market for something is efficient, most economists believe that most markets are efficient most of the time. So saying that the 20th market that we've looked at as efficient isn't news, and you're not going to get that published. If you write a paper that says the market for XYZ is inefficient, wow, you're saying there's free money that you can pick up here. Isn't that a puzzle that there's $100 on the table and people aren't taking it? Why is that? So if you write a paper titled "The Market for This Asset is Inefficient," well, if it's surprising and correct, then it might get published. It still has to go through peer review and other things. If you say it's inefficient and it's wrong, then you hope it doesn't get published. Okay, so I'm going to be talking about the market for index options, or options on the S&P 500, and these are quotes from several different well-respected authors in the finance field. Empirical evidence on option returns suggests that stock index option markets are operating inefficiently. Different paper. The most likely, or a different place in this paper, these are at least like 4 or 5 different authors, so I can't remember if this was in the same paper or not. The most likely explanation is mispricing. The option is selling for the wrong price. It's not selling for what it's really worth. A simulated trading strategy yields risk-adjusted expected excess returns during the post-crash period. Well, now there have been a few crashes. This refers to the crash of '87, right, as opposed to any other of the recent crashes. This quote, though, says it's not just that you're getting some excess returns, but even when you adjust for the risk inherent in the options, you're getting too much money. Another author, we find significantly positive abnormal returns when selling options. Put options appear to be overpriced. Strategies that involve shorting options have offered extremely high returns. These returns are hard to justify. So author after author, paper after paper, saying something that seems rather strange, that one of the largest options markets in the world is inefficient. Okay, so is it true or not? All right, so I want to tell you a little bit about put options, which I hope from capital markets or maybe from the options market class you know, but in case you don't, suppose we have a stock price that's stock that's selling for $100, 1 month maturity for a put option with a strike of 95. And this option is selling for $1. What does that mean? This put option is a contract that's going to give you certain payoffs in the future. If the stock goes up, this put option contract that you own gives you nothing. If the stock price stays the same, you get nothing. So why would you own a put option? Well, if the stock goes down below the strike, you get money. And if it goes down $5 below the strike, you get a $5 payoff. If it goes down $10, you get a $10 payoff. $15, you get a $15 payoff. So this is what a put option entitles you to. You pay $1 today, and 1 month later you get a random cash flow that depends on what happens to the stock. So put options make money when the stock goes down, and they're insurance against market declines. They're insurance against crashes, say. Okay. So when you look at an investment, one of the things you should ask first off is it a good deal? What's the expected return? And a lot of people don't ask this question when they're buying options. What's the expected return from buying an option? Okay? So if you bought a put option on the S&P 500, it depends on a lot of numbers, so I don't expect that you could come with a lot of assumptions. I don't expect you could come up with a number, but I just want to narrow it down to 3 alternatives: positive, 0, or negative. Okay? So if you buy a put option, how many people, we've got to raise your hand, and I would like everybody to at least vote for one, so don't abstain here. Raise your hand. Do you think the expected return from buying a put option is positive?
What time period?
1 month. 1 year. It doesn't matter. I'll give you, it doesn't matter. So if you think it depends on the time period, no. Okay. How many people think the expected return from buying a put option is positive? Couple? That looked like about 5 hands. 0. That looks like about 30 people. Negative. That looks like it's a little bit more. I'm really happy to see that because I've asked my classes this, and I think it shows what a deficiency I have as an instructor when almost everybody says positive. So I congratulate you. At least it was pretty close between these. 0. Well, positive seems reasonable because if somebody's buying something, you'd expect a positive expected return. Otherwise, why would you buy it? Okay? So there's an argument for the expected return of these things should be positive. 0, well, somebody's on the other side. If you're buying it, somebody's selling it, it is a zero-sum game. Maybe it's a 0 expected return for both people. But more hands went up for negative. So does somebody want to give me some intuition why you think it's a negative expected return? Yeah.
So I said negative for the person who is buying put options. If market goes down and he's already has paid a premium, which makes he's not getting anything, and then he's losing money on the premium. So it's a negative return.
So it's a negative return because you pay for the option and you generally don't get anything back.
Right.
Okay? Yeah.
Because you pay for volatility and you pay for time decay, and you're going to lose money in either way.
Okay, so what about a call option then? You're paying for volatility, you're paying for time decay. Would call options also have a negative expected return? Positive, yeah.
So a put option is a hedging instrument. So I
Right.
think about it, if you buy a put option and stock, the stock's going to have a positive expected return of the required return on stock. So since you're lowering your risk, the put option has to have a negative expected value.
Good. I like that because that's indeed the right explanation. So here's the intuition, the way I think about it. Expected return on the stock or the index is positive. Okay? Hope everybody would probably agree to that, right? Put options make money when the stock declines. So puts are effectively short stock positions. If the stock has a positive expected return and you're short the stock, that thing has a negative expected return. So put options have expected returns that are negative because it's effectively going short the underlying asset. So why would anybody buy a put option if it has a negative expected return? hedge, right? You're buying insurance, just like if you're buying car insurance or home insurance from your house burning down or whatever, you're willing to lose a little bit in expected value because you're not going to lose $200,000 or $1 million if your house burns down, right? Okay, so what happens in the real world? These are average monthly returns from 1987, the crash. Buying a put option has an average monthly return of nearly minus 60% per month, not per year, per month. Okay. That's an enormous, enormous return negative from buying a put option. Okay? The flip side of that is the person on the other side that's selling those put options is making a plus 57% average return per month, which is just extraordinarily large. Okay? So if you go back to this little example trying to explain what a put option is, the stock can go up or down. If the stock goes up, the return from the put is minus 100%. You pay $1 and you get nothing. So you lose 100% of your investment. It stays the same, you lose 100. But if the stock goes down, even not so much, you get a plus 400% return on the put option. Okay, taking into account the $1 that you paid for it. The stock is going up or down 10%. The put is going up 400% or down 100%. They're just enormous numbers because of the leverage that's inherent in the put option. Okay? So we want to try and make sense of this minus 57% return and try and figure out, does this represent a free lunch if you sell these things? And the problem is when you sell them, you make 100%, you make 100%, you make 100%. Month after month after month, you make 100% by selling these put options. But when the market crashes, as it did in October 1987, you can lose 500, 1,000, 1,500%. Okay? So these puts that are 6% out of the money expire worthless more than 90%. So you do this month after month after month. Most months you make 100%, okay, if you sell them. But, about 3% of the time, you lose 500% or more, 5 times your premium that you took in when you sold these. So selling put options has been very profitable, but it's really risky. You have this distribution that is, you're just making a killing until this market goes down a lot, and then you get, then you get killed yourself. Okay? Okay, so if you invest 3% of your money, you don't want to do all of your money in this, but if you put 3% of your money in this strategy of selling put options, and you have the other 97% in the money market or treasury bills or something, this is what the return you would get from that strategy. Starting in 1990, going on for more than a decade, your $100 fund value would grow to almost $10,000 compared to the S&P, which grew much less. So this is on a log scale. So these are, again, enormous returns when you're only doing tiny bits of this. This means you start off with $100, you sell $3 worth of puts. Okay? And you make 100%, so you make the $3. Then you make another $3, and you make another $3. So you're making lots and lots of money following this strategy. Anybody can do this. This is the problem. If you do it at the wrong time, or if you do too much of this is 20% of your money doing this, the scales are so enormous. I just want to point out, this only goes up to 10,000. This is going up to 100,000. So the scale is another order of magnitude bigger. And in a shorter time period, this is 4 years, in a shorter time period, your money goes from $100 almost to $100,000. Enormous returns until you go broke. The S&P looks like almost a flat line here until this happens. Okay? Lots of people follow this strategy. And if you do it enough times, and if you blow up enough times, like this, you get a New Yorker article written about you. So this is John Cassidy, who's written a couple of books and writes for, I think, The Economist and other things. So he's talking about Victor Niederhofer. He frequently sells put options, and I don't know, this quote is so obvious. Often this is good business, but whenever the market enters a volatile period, he's in peril. It's like saying, it's a good business until it isn't. It's pretty obvious. Nassim Taleb, who has made a big name for himself, calls Victor Niederhofer one of the most brilliant men I've ever met, yet he wastes his time selling options, something nobody can have any skill in, and it leaves him vulnerable to blowing up. What I actually find interesting about this is Nassim Taleb does the opposite. He actually buys puts waiting for the crash, and so he bleeds to death. He loses money, loses money, loses money. So you just take this thing and you flip it the other way around, and your money's going to zero, and you're hoping for the crash where you make a lot of money. And he's done this multiple times. He started a fund, he lost money, the investors gave up on him, it closed, he did it again. And then a couple years ago, he made a ton of money. And he gets in the news for doing this. But there's people on either side of this, and you can do whatever you want. But the question is, does it represent a free lunch? And our paper basically says that these returns that you see are completely consistent with what you would expect from option pricing models, the Black-Scholes model and others. And so what we show in this paper is there's nothing surprising about these 50, 60% returns from puts. Option returns are fair given the risks. These options markets, at least the trades that we're looking at, are efficient, and in this market there isn't a free lunch. So I haven't really gone into the details of this, but our findings are basically there's no market inefficiency, and this paper was published, and the reason that we could publish it is because all the other people said that they were inefficient. So you can publish something saying these other people are wrong. But I think Lori said she'll take questions at the end, so I'll move aside for a way.